Zero DTE options trading strategies can deliver big profits and big profits quickly, but you need a solid edge that's different than the crowd, or else you're just gambling. In this video, two of our most experienced traders team up to give you a method with a killer edge. I'm Mike Bellafiore, and we're one of the top proprietary trading firms located in New York since 2005 and proud to develop numerous 7 and even 8-figure per year traders. Watch, take notes, and learn from two professional traders on our desk so you can grow your trading account.
Hi, I'm Seth Froyberg, and I'm the head trader of SMB Capital's options trading desk here in Manhattan. And I'm here again with Garrett Drinan, who is our in-house expert on technical indicators, which is really a fancy way of saying that Garrett, through years of studying the markets and trading, has figured out that the market gives us strong clues as to how any particular market day is likely to play out. And these clues are picked up on in lots of different ways. And so today is the second part of our 4-part series on the subject of how to read what the market is telling us about how today is likely to play out and how we can then use zero DTE option strategies which utilize options contracts expiring the same day to capitalize on those clues. Now, in last week's video, Garrett covered the topic of market internals, and he demonstrated the 3 key indicators that he looks at to form his view of the way that the market's going to play out that day. Now, in today's video, we're going to be covering the second edge that Garrett uses to fortify his view of where the market's going to be on a particular day. And that's through a powerful watch list that he's created, which contains the ticker symbols of specific exchange-traded funds, ETFs, which when viewed together give you a pretty clear idea of whether the big money guys are dictating that today is going to be a risk-on, bullish kind of a day, or a risk-off, bearish kind of a day. And if we can figure that out, think of the edge you'll have, particularly with option strategies, where you can have awesome trade results with minimal downside risk. If you're absolutely brand new to options trading and you don't know much about options and how they work, we've created a video for you to understand options basics. And if you click the video appearing on your screen right now, it will lay out the groundwork for you to understand the strategy we're going to be sharing with you in this video. Then when you're finished, you can come back and watch the rest of the video. Okay, so with that said, Garrett, can you please tell us a little bit about how this ETF filter that you've built, how it works exactly to give us edge in the markets?
Yeah, so let's talk about some market ETFs here. So there are 2 reasons why I use this market ETF filter. One is to figure out what I might want to be trading, right? Because there are different areas of the market that are going to be in play on different days. And there are certain things that are going to be showing relative strength or relative weakness. And those could be entire sectors or areas of the market. And so that might mean I'm gravitating to high beta growth stocks for a reason, right? But the other reason, the second reason I use this market ETF filter is to assess the tone of the market. So on any given day, the market is going to have a different tone, right? And that could be a risk on tone. It could be a risk off tone. And so what I'm really trying to decipher with this is what is the risk appetite of the market? So what I'm asking myself every morning when I'm looking at this ETF filter, what are the sectors that are driving the move, right? We have our offensive industries and we have our defensive industries, and we can break these into categories. So for example, if we're seeing a big up move off the open, a big opening drive, I want to go look to see what is leading this rally. Okay, so if offensive industries are leading this rally, then I know that this drive is happening with a risk-on tone in the market. If defensive industries, and we'll cover these in a second, we'll cover the exact industries that I'm talking about. If defensive industries are leading the rally, then I might question whether this rally is sustainable because we're not getting the kinds of industries that typically signal risk-on leading this rally, right? So this is the overview of kind of why I use this market ETF. And then I'll show how I build it. We'll show mine. I took some screenshots on a particular day, and we can kind of use that day to demonstrate this. So the third thing I'm looking at are these thematic asset classes. And these can kind of change, but the market tends to trade around themes. And so we'll go over those as well, because that can also highlight the tone of the market on a given day. All right, so here's a very simple breakdown. And I'll show you my ETF filter in a second, and it has more ETFs than just these. But mine has a lot of ETFs in it, as you'll see. And this is because I've been looking at this for a while. And it has more than you'd probably need. So if you're just going to have a few ETFs in your filter, these are the ones that I would have. These are the basics. These are the big ones. I actually have them bold in my ETF filter because I really want to see what these are doing. So on the left, we have our risk on offensive ETFs, right? So this is technology, consumer discretionary, right? Stuff that people buy when they have extra money, when they have extra income, things that you don't necessarily need every day, right? SMH, the semiconductors, right? A big driver of the growth areas of technology are the semiconductors. So that's going to be a sector that I'm going to want to see lead on a really strong day, or lead to the downside, meaning be weaker than everything else on a really weak day. And then, of course, ARK, which is mainly filled with high growth technology and innovative types of companies that, again, is because it's centered around growth, it's going to signify risk on. Then we have our defensive ETFs. Okay, so this is utilities, consumer staples, right? The kind of things people buy no matter what, right? Like toilet paper and toothpaste and things that, are very, very steady companies that money will flow into often during an economic downturn, or even just one day of selling. There might be money coming out of these growth stocks and into these safer industries like your consumer staples, right? And healthcare is another one of those things, right? Everyone needs healthcare. And there's kind of a caveat to that, because sometimes there are biotechs that are very growth oriented and high risk within healthcare, but we're really talking about the large healthcare companies. And then, of course, UVXY, which is VIX. So implied volatility, right? When implied volatility is spiking, that can signify risk off in the market. And then on the right, we have our thematic macro themes. And these, again, like I said, these can change, but often, and over the past few years, like it hasn't been a mystery that the market has revolved around caring about rates, right? Interest rates, yields, inflation. And so these are the things that have a direct relationship with inflation and with rates, right? The US dollar, the TLT, which is the treasury bonds, right? And that's going to move inverse of rates. So that's a good proxy for rates. And then HYG, which is high yield bonds, right? So these are riskier assets that are very highly correlated to rates. And of course, you can watch crypto, because this is a highly risk on asset that tends to outperform when there's a risk appetite. Let's move to my ETF filter. I'll show you what it looks like. On the very far right, that's my entire ETF filter. And like I said, it has a lot of ETFs on there. You don't need that many, but that's just mine. Okay. And you can kind of pause the screen if you really want to look at like everything in there. But here's how I do it. So it's a basket of market ETFs, and I have a column for RVOL, and I have a column for percent change from the open. And that's really important because I really want to see how this stuff is acting off the open since 9:30. So since all the volume starts flowing in to the market during regular trading hours, that's what I care about, right? Because a lot of times big gap downs can get bought, big gap ups can get sold. And I want to see what is the money doing as soon as the volume comes in. And so that's why I do percent change from the open. And then I have a column for absolute change from the open. And the reason I do these is because I'm able to sort my ETF filter by each of these columns in order to see with RVOL what's in play, percent change from the open, what's strong and what's weak, and then absolute percent change from the open tells me the things that are the strongest or the weakest, period. And I have it color coded so that if it's above the open, it has a green background, and it's below the open, it has a red background. So here's the day that I'm going to show as an example. And this is just a day that I happen to screenshot my ETF filters. That's not something I do every day. And I can't go back in time and just grab any day with my ETF filter. So I actually took screenshots for whatever reason on this day of my ETF filter. And we'll just kind of go through. And you can see that this was a weak market day, right? There was a sustained offer in this market, and we did close at the lows. And there were some signs that this selling might continue because of what I was seeing in the ETF filter. Here we have the ETF filter sorted by RVOL. So like I said, this is going to show me what's doing the most volume. And so the way that I interpret that is these are the areas of the market that are most in play. And that's something I'm very interested in because I want to know on that day, what areas of the market does the market care about? And so in this case, it's, with HYG, we have high yield bonds, and they're actually extremely weak, right? So high yield bonds are getting sold. So that's a risk off signal. Volatility is getting bought, right? And that's in play as well, which is pretty unusual. And rates are higher because TLT is getting sold, and that's in play as well. So what this is immediately telling me is that today is a day that seems to be about rates and about that macro picture. And what's happening is that rates are moving higher. All right, so here is the same ETF filter sorted by percent down. So I'm now screening for the weakest areas of the market. So immediately right at the top, the weakest thing that we have in the market is ARK, right? And I can actually see 3 different ARK ETFs. So we can see immediately that growth stocks are getting sold. And we can see with GBTC that crypto is getting sold, right? So these are all risk off tone signals. And then consumer discretionary is getting sold as well, right? And that's another big one that we just covered, right? So now not only do we have the macro theme of rates going higher, but we have growth stocks being the weakest stocks in the market, right? So this is not a recipe for a rally. So if I'm looking for a reversal on a day like this, I'm looking at this ETF saying, well, wait a second, we might actually remain weak all day because there seems to be a theme happening here. So now I'll sort it by percent up. So I want to see what the strongest areas of the market are. So we already saw volatility when we sorted it by RVOL, right? But now we can see volatility is the strongest. Consumer staples are right at the top of the list, right? So your toilet paper companies and your toothpaste companies, right? And so when you see a rally or something like that, you don't want to see the toilet paper companies leading that rally, right? That's not what you want to see. So we see the dollars getting bought, right? That's another macro picture. And a lot of the times when we're afraid of rates going higher and we're afraid of inflation, a strong dollar does not favor a strong market, right? So this theme is just continuing and continuing as we assess this ETF filter. And then, of course, if we move down, it's below the open. It is red, XLV being healthcare, but it is relatively strong because we don't have many green sectors, period, in this market, right? So we can kind of see that the strongest market ETF is actually XLV here, which again, that's a defensive sector. So that doesn't really bode well either if that is the strongest sector.
Okay, so Garrett, let me jump in here for a few minutes because I'd like to give the viewers some insight into how options traders might view a situation where your basket of ETFs would clearly seem to be pushing a bearish narrative for the day. And the first thing I'd like to say, and which you emphasize in how you teach other people about the markets, is that this basket of ETFs is one information set that can have a big impact on the way you're viewing the market on any particular day. But like we discussed last week, suppose that on this day, this example that you're giving us from February 21st, 2023, about a year ago, you not only had this clear bearish picture emerging from your ETF basket, but you also had strong negative market internals like we covered in last week's video. In that case, then, you might form a view that we're getting a very strong confirmation from multiple sources now that this day the market's going to go south. And we can have a lot of conviction about it. And so under those circumstances, an options trader has the option of entering a trade where if you're outright wrong about the direction, you're going to lose, obviously, the trade. But if you're right, you can make a great return and have a great trade. So let's take a look at how we could make that happen. So let's move to right around 11 a.m. After, we've studied the market enough to know that we've got both the market internals and this basket of ETFs all pointing to pretty strongly a conclusion that there's going to be a continuation of a bearish day. So at this point, we have to ask ourselves this key question. How strong is our conviction that the market bearishness will continue throughout the day? And as Garrett has shared with me, his view is that his conviction is substantially strengthened if the market internals that we discussed last week, the vol ratio, the advanced decline line, and the tick are all bearish also. Then his conviction in the direction suggested by the ETF basket is significantly increased. Whereas if the internals are not particularly strong on their own, then he's going to be less convicted. So let's take a look at a way that we could have handled the trade on this day back in February of 2023. So as you can see, at 11 a.m. on that day, the Qs, which had been selling off for a week, continued their bearish tone, and by that hour had reached 296.28. So let's say that on that day, we not only had that bearish information derived from the ETF basket, but we also had the strongly negative market internals that we discussed in last week's video. Then in that case, we can classify our conviction as strong. And so we can enter into a trade that's a little bit more aggressive. And so let's say that at 11 a.m. that day, we found a put trading just a point below where the market was trading, the 295 put on the Qs. And we went ahead and bought 40 of those. And then simultaneously, we sold right below that 40 of the 294 puts. Again, both puts expiring that same day. Well, when we do that, buying a put higher up on an options chain and selling a put below that, we've executed what options traders refer to as a put debit spread. Okay, so now let's see what's happened here so that we can understand our risk on a put debit spread. You see, when we buy a put debit spread, the cash flow goes like this. We bought 40 of the 295 puts, but remember, each put represents the right to sell shares of the Qs at the put strike price. So you multiply that price by 100, and you bought 40 of them. So when you multiply it all together, you've paid $2,360 for those 40 puts. But then we sold 40 of the 294 puts for 32 cents. So using the same kind of calculation to figure out how much you receive back for selling those puts, you get $1,280. And so when you net that out of what you spent for the 295 puts, you arrive at a cash outflow, in other words, a cost of $1,080. And that's your risk for the trade. Now, why do I say that's the risk on the trade? Well, think about it. At any closing price above 295, the 295 put expires worthless because the right to sell a stock below where it's trading is obviously nothing at expiration. And the same thing, of course, is true for the puts we sold at 294. They're worth nothing. And so what we're saying here is that if the stock doesn't continue to sell off below the stock's price when we entered the debit spread options trade, then we're going to lose that $1,080 at expiration. But on the other hand, if the stock does continue to sell off and gets below 295, then the debit spread can become very valuable, which is exactly what happened in this case. The ETF basket proved right, because if we move to 4 p.m. that day, we can see that the Qs closed at 294.03 on that day, the day that they expired. And so the way you determine the value of puts at expiration is to first determine if the stock's price had closed below the put's strike price. And if it did, then you take the strike price, which in the case of the 40 puts we had bought was 295. So we subtract from 295 the closing price, which is 294.03, and that results in an ending value of 97 cents for that option. Why? Because that put confers on the owner the right to sell 100 shares of the Qs for each share he owns for 97 cents more than they're actually worth in the open market at the close. And so as you can see from the calculation, that right for those 40 puts is worth $3,880. But then turning to the 40 puts we sold at 294, well, those actually expire with no value because there's no value to the right to sell shares at 294 when they can be sold in the open market for 294.03, obviously 3 cents higher. And so those options simply expire worthless, resulting when you subtract out the original cost of the trade a profit of $2,800, which is a 259% return on the trade in less than a day. And so our strong conviction paid off, and the debit spread was, very successful. Now, let's take a second case though. Let's say that hypothetically on this day, that the market internals were not really strongly negative. Perhaps they were kind of neutral or maybe just slightly bearish. Well, then in that case, we would enter a less aggressive trade. And a very good example of a much less aggressive trade would be a slightly out of the money call credit spread like we've entered in this example. Now, call credit spread differs from a put debit spread in that when you sell a call lower on an options chain, and you buy a call higher on that same options chain, we don't pay money. Actually, we receive money, which is why it's called a credit spread. And that's because calls closer to the price of the stock are more expensive than calls farther away from the stock's price, because the market doesn't have to move up very much for that call to have value at the end of the day when it expires. So that's in the case of the 297 call. When the stock is trading at 296.28, it doesn't take much to get to 297, but it takes a much bigger move for the stock to get to 298. And so that 298 call is less likely to have any value at all at the end of the day. And so the call more likely to have value is going to have a higher price than the call having less of a likelihood of value. And this was clearly the case here, where the 297 calls were trading for 80 cents, therefore bringing in $1,200 in cash. But the 298s that we bought for protection, those cost us only $720, resulting in net positive cash flow of $480. Your broker is going to require you to have at least $1,020 in your account, which is also the worst case scenario loss on the trade. Just like the worst case scenario loss on the put debit spread, which was the $1,080 figure that we paid for that put debit spread. So we tried to create an example here for you where the dollar risk is about the same as the put debit spread trade. So now, even though the same dollars are being risked with the call credit spread as they were with the put debit spread, why do I say that this is a much less risky trade? And this is important to understand. So I want you to think about it. When the trade is executed, we immediately received cash, right? That $480. So the goal of a call credit spread trade is to keep that cash that you received when you opened the trade. And the Qs were trading at 296.28 when we entered the trade, which was below both the 297 calls we sold, and even farther, of course, obviously below the 298 calls we bought. And calls only have value if the market closes above that call strike price at expiration, because they only have value if that call gives you the right to buy the stock for cheaper than it's trading in the open market. If the stock closes below its strike price, then the call logically has no value at expiration, which is what you want in this case. You want the calls to expire with no value, because then you get to keep that cash that you got at the beginning of the trade, and the options just die and go to options heaven. And that's exactly the outcome you want. And so if you think about it, even if the ETF basket was wrong and the stock had rallied by the end of the day up to 297, we would still win the trade. Why? Because unless the lowest calls prices exceeded by the stock's price at expiration, it has no value. And at every closing price up to 297, those calls still have no value. And so the trader just keeps the $480 in cash. And he gets to keep that same amount of cash if the stock goes up to 297, and of course, at any price below that. And so when the market closed that day, as you'll remember, the Qs were priced at 294.03. And so recalling that we received that $480 in cash originally, then valuing the final profit on the trade is pretty easy, because both the calls we sold at 297 and the ones we bought at 298, those expire worthless, resulting in you're just keeping the cash you received when you sold the call credit spread in the first place as your profit. And so comparing the two strategies, you can see that generally, if your basket of ETFs is flashing a strong bearish signal and you're getting confirmation from the market internals, then you can go for it and put on an aggressive trade like the out of the money put debit spread. And if you're right by enough, you can get a big win, which in this case was $2,800 on a pretty small amount of risk. Whereas I'd argue the call credit spread is your better choice for the case where your basket of ETFs is pointing bearishly, but you don't have super strong confirmation from your market internals, in which case you want to trade where there are more scenarios that can give you a win, including that you were outright wrong and the stock actually rallied a little bit. And as we just covered, even in a mild rally, like a bounce up to 297, you still win. And it's a full win, which is pretty amazing if you think about it. But of course, the win is much smaller. In other words, if there are less scenarios for a win, you'll get rewarded more with option strategies. And conversely, the more scenarios where you can win, the less you can make on an option strategy, which intuitively I think makes sense to most people. Okay, so Garrett, did you have any final thoughts for us on this subject of the ETF basket?
Yeah, great. So let's zoom out just a little bit and see if we can kind of fit it all together and just put a little bit of color on the trades that Seth just outlined. It's really important to note that this market ETF filter, it's not going to stand on its own all the time. And most of the time it won't. It's a very, very powerful tool that gives me a lot of information. But this is why Seth outlined two different trades. And I love how he did this. I thought this is great because it kind of puts into context all three of the things that are important to me. Okay, so we talked about the market internals last week in the first video in this series. And if you missed that, you can go back and watch it, and we can link it in the comments below. That is key if I'm looking for a trend day, right? So this is why Seth outlined an aggressive trade when we had all the market internals pointing to the potential of a trend day. And then we had the ETF filter confirming that we have a very particular risk appetite, risk on or risk off tone in the market. In this case, risk off in these examples, of course. So it's very important to differentiate, as Seth did in those trades, that there is a huge difference between when we have everything pointing in our favor or just the market ETFs. If we just have the market ETFs in our favor, it might just mean that, like in this day, when we saw a lot of risk off signals in the market ETFs, it might just mean that we might have a hard time rallying. It doesn't necessarily mean that we get crushed and trend all day, right? So this is why it's really smart to think about the two different option strategies that Seth outlined and why each one is specifically catered to each scenario. And so the third thing that I always look for, of course, is the price action, right? I want the price action confirming what I'm seeing in the market internals and the market ETFs, right? If I'm seeing a risk-off tone in the market ETFs, I want to see that they're selling the indexes, right? That's very important to me because I'm not just going to blindly fight a rally. But if we get that weak price action and we have negative internals and a risk-off tone in the market, then for me, that gives me a lot more edge to make the call and to put on these types of trades that Seth is outlining here.
What I'd like you to take away from today's video is that professional traders are informed by the behavior of ETFs representing different market sectors, and it allows a trader to form a bullish or bearish bias for the day. But it's very important to understand that you can have varying levels of conviction about a trade, and that can come from the other indicators that you use to determine market direction for the day, like the market internals that we covered in last week's video. And so option strategies are so flexible that you can make choices between strategies based on your level of conviction for any given trade. And as you can see, there will always be a trade-off like we just discussed. A better reward for a trade where basically only one scenario wins the trade, such as the put-debit spread, or you can choose a lesser win where you're less convicted about the trading day, where while you don't make as much, your chances of winning are so much higher that it may be worth it, like in the case of the call credit spread, where pretty much any scenario, except you're being really wrong about the day's direction, would have resulted in a modest but pretty satisfying win nonetheless. These kinds of trade-offs are understood by professional traders, and now you've got a little bit of the insight to apply these two option strategies yourself, depending upon your conviction level on a trade. All right, so thanks, Garrett, and to all of you, we're looking forward to sharing part 3 of this series next week on trading 0 DTE options using market indicators.
Now, if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up or down or sideways, and how to make money on a stock or index trade even if you're wrong on the direction, then click the link that's appearing right now at the top right-hand corner of your screen. That will open up the free workshop registration page in a new window. So don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com.